Chart reading, short lesson. Chart reading is one of the most important skills in trading because the chart shows the battle between buyers and sellers. Before taking a trade, a trader should understand what price is doing, where key levels are, and whether the market is trending, reversing, or moving sideways. Start by learning how to use TradingView because it gives you the tools to study price action, draw support and resistance, add indicators, and review different time frames. Next, learn candlesticks. Each candle shows the open, high, low, and close for a specific period. Candles help traders understand momentum, buying pressure, selling pressure, and possible reversals. Then focus on support and resistance. Support is an area where buyers may step in. Resistance is an area where sellers may step in. These levels are important because price often reacts around them. After that, learn trend lines. A trend line helps you see the direction of the market. In an uptrend, price makes higher highs and higher lows. In a downtrend, price makes lower highs and lower lows. Then study chart patterns such as breakouts, pullbacks, double tops, double bottoms, flags, triangles, and head and shoulders. These patterns help traders prepare for possible moves before they happen. Finally, always look at a volume. Volume shows how much activity is behind a price move. A breakout with strong volume is usually more meaningful than a breakout with weak volume. Key point. A good trader does not just look at one candle or one indicator. A good trader reads the whole chart, trend, levels, candles, patterns, and volume together. Lesson goal: chart reading. By the end of this lesson, students should be able to open a chart and explain what price is doing. They should not just look at candles randomly. They should understand the story behind the chart. First, students will learn how to use basic TradingView tools, such as drawing lines, changing time frames, adding indicators, and marking important price levels. Next, they will learn how to read candlesticks. Candles show buying and selling pressure. A strong green candle may show buyers are in control, while a strong red candle may show sellers are taking over. Students will also learn how to mark support, resistance, and trend lines. These areas help traders understand where price may bounce, reject, break out, or reverse. They will then learn how to recognize simple chart patterns such as higher highs, lower lows, breakouts, pullbacks, double tops, and double bottoms. Finally, students will learn how to use volume to confirm strength or weakness. If price moves up with strong volume, the move has more power. If price moves up with weak volume, traders should be careful. Main idea: a chart shows buyer and seller behavior. When students learn to read the chart correctly, they can better understand what the market is trying to do. TradingView Chart Platform. Short lesson: TradingView is a charting platform traders use to study price action, mark important levels, and follow different markets. It is one of the best places for beginners to start because it is visual and easy to use. The first thing students should learn is how to open a ticker symbol, such as a stock, ETF, crypto, or futures contract. After opening the chart, they should learn how to change the time frame, such as 1 minute, 5 minutes, 1 hour, daily, or weekly. Next, students should learn the basic tools. These include the watch list, drawing tools, indicators, alerts, and compare tools. These tools help traders organize charts and study market movement. A good starting process is simple. Open the ticker, choose candlestick charts, pick the time frame, and mark the key levels before adding indicators. The most important warning is do not overload the chart. Too many indicators can confuse traders. Price, levels, trend, candles, and volume should come first. Main idea: TradingView is the workspace, but the trader must learn how to read the chart properly. The goal is not to add many indicators. The goal is to understand what price is doing. Candlesticks. Short lesson. Candlesticks are one of the first things every trader should learn because they show what happened during a specific time period. Each candle has an open, high, low, and close. A green candle means price closed above where it opened. This usually shows buyers had more control during that candle. A red candle means price closed below where it opened. This usually shows sellers had more control during that candle. The body of the candle shows the strength of the move. A big body usually means strong control by buyers or sellers. A small body usually means the market is pausing or unsure. The wicks show rejection and failed prices. For example, if price pushed higher but then came back down, the upper wick shows sellers rejected that higher price. If price dropped lower but then came back up, the lower wick shows buyers defended that lower price. Main idea candles show the battle between buyers and sellers. When traders understand candle bodies and wicks, they can better understand momentum, rejection, and possible turning points. Candlestick patterns. Short lesson candlestick patterns help traders understand possible changes in buyer and seller behavior. A pattern can give clues, but it should not be used alone. It is stronger when combined with trend, support, resistance, and volume. A bullish pattern may suggest buyers are stepping in. Examples include a hammer, bullish engulfing candle, morning star, or a strong candle closing near the high. These can be more useful when they appear near support. A bearish pattern may suggest sellers are taking control. Examples include a shooting star, bearish engulfing candle, evening star, or a strong candle closing near the low. These can be more useful when they appear near resistance. A neutral pattern shows pause or indecision. Examples include a doji, inside candle, or narrow range candle. These patterns often happen before a larger move, but traders should wait for confirmation. Teaching point: a candlestick pattern at support or resistance is more meaningful than a pattern in the middle of nowhere. The location of the pattern is just as important as the pattern itself. Timeframes. Short lesson. Timeframes are very important because the same stock can look different depending on which chart you are looking at. A stock may look bullish on the daily chart, but bearish on the 1-minute chart. A 1-minute chart is mostly used for scalping. This is for very short-term trades where traders are looking for quick moves. A 5-minute chart is often used for day trading. It gives a little more structure than the 1-minute chart and helps reduce some noise. A 15-minute chart helps traders see intraday structure. It can show stronger support, resistance, and trend direction during the trading day. A 1-hour chart is useful for swing trade setups. It helps traders see bigger moves and cleaner patterns. The daily chart shows the major trend. Before taking the trades, traders should know whether the daily chart is trending up, trending down, or moving sideways. The weekly chart gives the long-term view. This is helpful for investors and for understanding the bigger market story. Main idea: always know what move you are trading. Are you trading the 1-minute move, the daily trend, or the long-term investment story? A trader must match the time frame with the type of trade they are taking. Support and resistance. Short lesson. Support and resistance are some of the most important areas on a chart. These levels help traders understand where price may stop, bounce, reject, or break out. Support is an area where buyers may step in. When price falls into support, traders watch to see if buyers defend that area and push price back up. Resistance is an area where sellers may step in. When price rises into resistance, traders watch to see if sellers reject the move and push price back down. Support and resistance should be treated as zones, not exact pennies. Price may go a little above or below the level before reacting. One important idea is that old resistance can become new support after a breakout. If price breaks above resistance and later comes back down to test that area, buyers may step in and defend it. Main ideas support and resistance show important battle zones between buyers and sellers. Traders should always mark these areas before taking a trade. Trend lines. Short lesson. Trend lines help traders see the direction of price movement. They make the chart easier to understand because they show where buyers or sellers are stepping in. An uptrend line is drawn by connecting rising lows. This means price keeps pulling back, but buyers continue to step in at higher prices. It shows strength and buyer control. A downtrend line is drawn by connecting falling highs. This means price tries to bounce, but sellers keep stepping in at lower prices. It shows weakness and seller control. Trend lines are not perfect exact lines. They should be treated like zones. Sometimes price may touch the line, slightly break it, and then continue the trend. A trend line becomes more important when price touches it multiple times. The more times price reacts at the trend line, the more traders will watch that area. Main idea trend lines help traders organize price action. In an uptrend, connect rising lows. In a downtrend, connect falling highs. The goal is to understand who is controlling the move, buyers or sellers. Trend direction. Short lesson. Before taking any trade, the first question should be, is the market trending or moving sideways? This helps traders choose the right strategy. An uptrend happens when price is making higher highs and higher lows. This means buyers are in control, and traders may look for buying opportunities on pullbacks. A downtrend happens when price is making lower highs and lower lows. This means sellers are in control, and traders may look for selling opportunities on bounces. A sideways market happens when price moves between support and resistance with no clear direction. This is also called a choppy or ranging market. The biggest mistake is using a trend-following strategy in a sideways market. In choppy conditions, price can move up and down quickly and create false signals. Main idea. First, decide the market condition, uptrend, downtrend, or sideways. A professional trader does not force a trend strategy when the market is choppy. Chart patterns. Short lesson chart. Patterns are repeating structures that traders watch for possible continuation or reversal. They do not guarantee a move, but they help traders prepare for what price may do next. A bull flag happens after a strong move up, followed by a small pullback or sideways pause. This can show that buyers are resting before possibly continuing higher. A bear flag happens after a strong move down, followed by a weak bounce or sideways pause. This can show that sellers may still be in control and price may continue lower. A double bottom happens when price tests a low area twice and holds. This can show buyers are defending support. A double top happens when price tests a high area twice and fails. This can show sellers are defending resistance. Ascending and descending triangles show pressure building at a key level. Traders watch for a breakout, but they should wait for confirmation instead of guessing. Main idea. Patterns are probabilities, not guarantees. A pattern becomes stronger when it happens near support, resistance, trend lines, or with strong volume confirmation. Volume confirms the move. Short lesson volume shows how much trading activity is happening behind a price move. Price tells us direction, but volume tells us participation. A high volume breakout is usually a stronger signal because it shows many traders are participating in the move. This can mean the breakout has more power behind it. A low volume breakout is usually weaker. Price may break a level, but without strong volume, the move may fail or reverse quickly. Heavy selling volume can be a warning sign. It may show that sellers are taking control and buyers are not strong enough to hold price up. Heavy buying volume can show demand is increasing. This may mean buyers are stepping in with strength, but traders must also be careful. A volume spike after a long run can sometimes mean exhaustion. This means many buyers or sellers may be entering late, and the move could slow down or reverse. Main idea price tells direction, volume tells participation. A good trader uses volume to confirm whether a move has strength or weakness behind it. Simple chart reading process. Short lesson. A simple chart reading process helps traders stay organized and avoid guessing. Instead of jumping into a trade right away, traders should follow the same checklist every time. First, open the chart on TradingView and choose the ticker you want to study. Second, choose the correct time frame. Decide if you are scalping, day trading, swing trading, or investing. Third, identify the trend. Ask yourself if price is making higher highs and higher lows, lower highs and lower lows, or moving sideways. Fourth, mark support and resistance. These are the important areas where price may bounce, reject, or break out. Fifth, draw trend lines to understand the direction and structure of the move. Sixth, look for patterns and candlesticks. Watch for signs of strength, weakness, rejection, continuation, or reversal. Seventh, check volume. Volume helps confirm whether the move has strong participation or weak participation. Finally, build the trade idea. Decide where the possible entry, stop loss, and target could be before taking the trade. Main idea. The goal is not to predict every candle. The goal is to identify high probability areas where price may react. A repeatable process helps traders make better decisions and avoid emotional trading. Teaching summary. Chart reading. This lesson brings everything together. Students should remember that chart reading is about understanding what price is doing, not guessing. TradingView helps traders study charts, mark levels, use drawing tools, add indicators, set alerts, and compare markets. Candlesticks show buyer and seller pressure. The candle body shows strength, and the wicks show rejection or failed price moves. Support and resistance show the key areas where price may react. These are important zones where buyers or sellers may step in. Trend lines help traders see market direction. They show whether buyers are stepping in at higher prices or sellers are stepping in at lower prices. Chart patterns show common setups that traders watch for continuation or reversal. Volume helps confirm whether a move has strength or weakness behind it. Closing line. If fundamentals tell you what to buy, chart reading helps tell you when to buy, when to sell, and where price may react.